This is Cover Your Assets, the podcast where the insurance advisory's important conversations happen. Each episode, we talk with leaders from across the insurance industry to tackle the protection, practice, succession, and estate planning solutions that matter most to insurance and wealth professionals today.
Here's something that surprises a lot of advisors when they hear it. A business owner can spend decades building something genuinely valuable. They can have a shareholder agreement, a will, a holding company, a solid accountant, a great lawyer. They can have done everything right on paper. And still, the day they die or the day they try to exit, the whole plan can fall apart. Not because the structure was wrong, but because there's no cash to make it work. The taxes are due, the buyout price is owed, the kids who didn't work in the business need to be treated fairly, and the business itself needs to keep running. That's 4 problems, and they all land at the same moment. Today, we're talking with someone who spends his days helping the most sophisticated advisors in Canada solve exactly that problem and that kind of problem for their largest clients. He's a large case specialist at Ayal Financial Group, and he's going to walk us through why advanced insurance strategy isn't a product category for the business owner. It's a succession funding mechanism, an elegant one, and why every advisor working with business owners needs to understand how to access it. This is Cover Your Assets. I'm Pierre Daillie.
I'm Ayal Cohen.
Let's get into it. Eric, welcome. It is terrific to have you on the show.
Thank you so much for having me. I've been looking forward to this, and thank you for a great introduction. You are right. A lot of people think of life insurance as a product, but it is a very eloquent solution. So I love how you put that.
Excellent. So joining us is Eric Orr, who's a large case specialist at Ayal Financial Group. Eric, thank you so much again for joining us. Before we get started, I think it would be great if you could please tell us a little bit about your background, the arc of your career, how you ended up specializing in advanced insurance and estate planning. What was your aha moment?
So I've had a very interesting career path. I started about 25 years ago as a financial advisor. I am actually still an active financial advisor as well. I never really gave that up. Got into management, focused a lot on training. So I did a lot of training in new advisors, got into recruiting, development of advisors, and then eventually got into insurance wholesaling about 12 years ago. And that's when I really fell in love with what insurance can truly do, really specialized it and got into that large case market. At the end of the day, when an advisor's dealing with a larger case, many of them panic because they think that somehow this client is different than every other client. So they come running to me and going, Eric, help me. I've got a business owner. I've got this large case. I don't know what to do. When in reality, it's got to do it a bit different. Well, that really got me into that large case space and got a chance to really see the value that it can bring to estates and how we were saving some estates millions and not tens and billions of dollars and protecting those assets for them. And just fell in love with it. I've been doing it ever since. Did a few other roles, but about a year and a half ago, joined IA. They had an opening as for their advanced case or large case sales director here in Ontario, and that's kind of like ended up with IA at that point. And now spend my entire day focusing on specifically just these large estate cases and having lots of fun doing it.
I bet it sounds, just superficially, it sounds very gratifying. And I think when you can have that kind of an impact for folks who have worked very hard in their lives, attained success, and then reach that point where they just simply don't know, how to solve or how to crack that nut, how to solve that problem of transitioning their success to their children, to their family, to their spouse. To the next generation. We're facing this incredible, great transition of trillions of dollars in the next, 5 to 15 years, as, business owners age. And, it's such a timely conversation and looking forward to it. So thank you for sharing that. And Eric, most advisors who work with business owners know that their complex client is complex. What they often don't know is how specific the failure modes are. We often think about what we can do right, but we don't very often think about what can go wrong. And that's the thinking that really deserves far more attention than it gets. Yeah. And before we talk about solutions, we want to name the actual problems clearly, because the reframe only works if the problem is real and visceral for the owner. Eric, you've seen the inside of a lot of large cases. Let's start there. When a business owner's succession or estate plan fails or comes close to failing, what does that actually look like? What are the pressure points that show up most often, and which ones tend to catch even well-advised owners completely off guard?
Excellent question. The reality is there's many different ways that these can fail. All of them come right down to effectively bad advice. Whether it be bad advice from their financial advisor, insurance advisor, their tax and legal team, or even other trusted sources. I mean, I've seen cases where clients come to me and say, well, my neighbor told me this and that. And I'm like, oh, no, not this again. So the neighbor was a trusted source and the neighbor had a really bad idea. But ultimately, everything funnels down to just bad advice. Most of the time, it is genuinely not intentional. It's not people intentionally trying to give it bad advice. They just don't know what they don't know. And as a result, structures are not put in place properly, or individuals inadvertently don't do the most efficient thing possible for their client. They don't have the right structure in place, or the right tax planning in place, or post-mortem planning. And as a result of that, you end up spending a lot of money to CRA instead of leaving it to your family. The other issue that we see, so not only can we see catastrophic destruction of a family's net worth to CRA with some really bad tax planning, but in a lot of cases, we also see it with infighting in a family where equalization provisions were not put in place. And again, this comes down to bad advice, where the financial advisor didn't step up and say, hey, you're leaving the business to one child, your other two children are not getting the business. What are we doing to make them happy? So you have to have that discussion of what is fair versus what's equal. They're two very different things. And equal doesn't always equal fair. And sometimes fair doesn't mean equal either. So it's very important that there be a very clear intent on behalf of mom and dad with what they want to do with that estate, and ensure that all children are treated fairly, however that comes out to be, whether it be, you get the cottage, you get the house, you get the assets, you get the business, whatever. And all that really comes down to getting good advice. And something that I find too many families don't do, because talking about money is a taboo, and it shouldn't be, but unfortunately it is. Have family meetings. It is such a simple solution. Financial advisors should, whether it be a wealth advisor or insurance advisor or not, have a family meeting. Have mom and dad talk with the kids and say, this is what's in our will. We're not going to hide it. This is what's in the will. This is what we're trying to do, why we're trying to do it. Here's the financial advisor. Here's the accountant. Here's the lawyer. You're all in a room. Before anything happens, let's discuss it. Let's put everything on the table so everybody knows that we're going to avoid the infighting. We've all seen the headlines, wealthy billionaire dies and suddenly all the children are in court fighting for scraps. Meanwhile, the only people making money, CRA and the lawyers. We've all seen this again and again in the headlines. Proper planning, having good advice do help to avoid that catastrophic failure. It's where the family is on side, they're happy with what they're getting, so the lawyers aren't going to be sitting there fighting in court. And with some really good pre-death planning and post-mortem planning, we can cut CRA out as much as we can and leave as much as possible to be into the hands of the children. And of course, throw in a bit of life insurance, and in many cases that can actually increase the value of the estate while getting everybody off your back as well. So that's what success side of things. But yeah, when we see failure, it's usually bad advice. Improper planning, unfortunately, leads to some pretty ugly situations, and we've all seen it play out in the headlines.
Wow, it's pretty overwhelming if you put yourself in those shoes for a moment. I mean, for the, for the beneficiaries of an estate, I mean, you mentioned, the family issues. That's, that's emotional grief that really, until it actually happens to you, you don't weigh it financially. You weigh it, you weigh it financially, but you don't necessarily weigh it emotionally. That can lead to family splits, right? I mean, it's not, it's people laugh about it sometimes, often, the cousins aren't talking anymore, they joke around about it, but really in passing, and when you actually stop to consider it, how would you feel if you were on, how would family members who are on the short end of, of an estate feel about those who are on the long end of the estate? And you can see where that would cause dramatic rifts. So that's the emotional side. I think the emotional grief. There's also the time factor. When things aren't properly structured in an estate, the family, the beneficiaries can be left waiting for an
Years.
Unbelievable amount of time, more time than they ever imagined or even thought about. Thought about. Again, it's a don't know you don't know until it happens to you. The courts, CRA can tie things up indefinitely. You mentioned the tax exposure at death. For advisors who are, in the room, who work on the wealth side and may not have done this math recently, can you give us a rough picture of what that tax bill looks like for a business owner with, say, $5 or $10 million in corporate retained earnings? Not a specific case, of course, just a sense of the scale of the problem.
Yeah, absolutely. And this is where I think even some of the best educated advisors get caught off guard on this one. There is, with business owners, a very legal form of double taxation that CRA has in place. And if you don't plan properly, you could pay tax on the same thing twice. And CRA is not going to tell you, hey, did you know if you did something a bit differently, you would not have to pay us this? They're not going to tell you this. And this is what catches a lot of them off guard. When mom and dad die, you pay obviously capital gains on the growth of the value of the business. Most of the time, if it was a startup business and it's worth $10 million, that is a $10 million capital gain. You end up paying about, call it $2.6 million, give or take, at the highest marginal rate. Then, when the kids are going, great, we have all these assets in that holding company, we want to pull the assets out. Well, to take the assets out, it's not, well, mom and dad paid capital gains. There was $10 million. Now the fair market value is $10 million. I can pull that money out tax-free. No, it's a dividend when you pull it out of the corporation. So you can pay capital gains on the value of the shares when mom and dad die, and then you pay dividends to pull all that cash out on the next generation. That's double taxation. And it is completely legal. CRA wrote the Tax Act in a way that allows them to do this. The good news is there are provisions in the Income Tax Act where you can restructure the estate. This is where you need that really good legal and tax advice, where there are two real strategies that we can put in place, whether it be using Section 164 in the Income Tax Act or a pipeline strategy. Those two strategies do allow you to basically restructure the estate in such a way that you can avoid one or the other tax. And it's just the way the accountants work with some loss carryback provisions. And I'm not an accountant here, so I don't want to go too much into detail because I'll be a little out of my depth and I don't want to lead anybody astray. But at the end of the day, a really good accountant will know how to use these two strategies and apply one or the other to eliminate either the capital gains or the dividends and help them save some money. And that's just done by integrating the two transactions from the final tax bill through the estate taxes, and then finally into that next generation. We kind of integrate them and just do some backward loss provisions to offset some of the taxes. So there are strategies, but most tax accountants that don't deal with post-mortem don't know this. And a lot of advisors in their mind going, okay, mom and dad are going to have a $2.5 million tax bill. I'm going to sell a $2.5 million policy. It took care of the tax. There'll be $10 million for the kids. But then forget that next step of, well, the kids still have to pay a dividend to pull that money out. Now it's a $10 million dividend. They're going to lose almost half of that. If assuming it's a non-eligible dividend, almost half it goes to taxation. So the insurance is great, but it can't stop there. You have to do a combination of strong post-mortem planning with, an insurance advisor or risk management advisor and an accountant who understands post-mortem taxation, not just how do I get the most deductions possible out of your income tax every single year. There are some accountants that are really good at that, but don't understand the post-mortem aspect of it. So you need to get that really good advice. You combine those two together. And in many cases, if you have a really good, strong insurance solution, there are scenarios where that $10 million actually grows. It could be 11, 12, 13 million, even after the taxes, when you include a strong post-mortem strategy with a really strong insurance solution in that holding company. With two together, there are ways that we can actually increase it. So you can go from, fail where you're paying almost 2/3 the CRA and have 1/3 of the 10 million left over to actually with the right planning, we've grown it. CRA got a bit of money, but the kids get even more. And that's how you see wealth growing from one generation to the next. You see, well, a lot of wealthy families do that. That's one of the ways that they grow their wealth, intergenerationally is with that proper post-mortem planning. And an insurance solution. So insurance is not a dirty word. I know a lot of people think that. I'd often tell them, joke, if I'm on an airplane and, I don't feel like talking to the person next to me when they say, what do you do? I just look down with a big smile and go, I sell life insurance. Yeah. And that usually, that's when they're like, oh, and they put the earbuds and they just start watching a movie. I'm like, I can read my book in silence now. That's when I'm feeling really antisocial. But it's not a bad word. The reality is when you know how to use it, it is a amazing tool. And we can use the Income Tax Act against CRA. There are so many provisions in there, what you can do with life insurance that really cuts them out. And we can really leverage the Income Tax Act to the benefit of the client, not CRA, which is what it was written to do initially.
That's a really important takeaway, Eric, because that you're really talking about having a difficult conversation with the family. When Pierre brought up plan failing, my mind essentially went to, well, the insured has died and there was no plan. And now we got to pick up the pieces. What you're saying is have that difficult conversation and do the uncomfortable, really, as Pierre said, emotional post-mortem planning. That's really key.
Eric, buy-sell agreements are common. Most business owners with a partner have one, or they think they do. Where do buy-sell arrangements actually break down in practice? And how often does that breakdown come down to a funding problem rather than a drafting problem?
Excellent question. At the end of the day, some of the issues that we see with shareholder agreements, assuming they even have one, you'd be shocked at how many business owners do not even have a shareholder agreement. But one of the issues from a drafting point of view is they drafted it when they started the business, and that could have been 10, 15, 20 years ago, or in some cases, 30, 40, 50, 60, $100 million of value ago. So what's written it is irrelevant. Everything's changed. And then you run into a second issue, as you had alluded to, of the funding issue, where suddenly it's great to say, okay, now, Pierre, you and I are business partners. Anything happens to me, you buy out my family, anything happens to you, I buy out your family at a fair price. You and I might be smart and say, well, fair price will be determined by this equation, not a fixed value. That's often what I see is going, oh, our business is worth $5 million today. Well, we buy each other up for $2.5 million. Well, 20 years go by and the company's worth $100 million, and the provision says, oh, I can buy your family out for $2.5 million. Your family's like, well, hang on. Hang on.
Whoa, yeah.
It's, my spouse's or my parents' share is worth 50. Well, the provision says I buy for 2.5. Too bad, so sad. Here you go. So that's obviously a drafting issue. And you see a lot of that, but let's just assume that you and I had an equation that brings it roughly around 50 million bucks. Where am I going to find $50 million to buy your family out?
Right.
I can go to the bank and say, well, I need a $50 million line of credit in my business on top of any other loans that I have. The banker's going to look at me and say, well, it was the Pierre and Eric show. Pierre was the salesman. You were the designer. Who's going to sell your solutions with Pierre being gone? I'm not prepared to lend you $50 million when your main revenue generators out of the business. So that's not going to work very well. I can try and liquidate some assets. Well, okay, what assets can I liquidate? Depending on the business, I may not be able to liquidate half of the value of the business. That may not be feasible. Maybe I need to find someone else who's willing to buy your shares, but now I'm getting into bed with someone else I don't really know. And are they willing to pay dollar for dollar the 50%? Maybe, maybe not. So there's a lot of challenges there. Needless to say, something like a life insurance solution helps that funding. And that's when we are doing buy-sell agreements, we often strongly encourage that we look at some forms of insurance, whether it be life insurance for death. It could be disability buyout insurance in the event of a disability. Even critical illness comes into play here. Because in the provision, we want strong provisions, not just if someone dies, but what if someone has a permanent disability? They're not dead,
Absolutely.
but they can't work in the business anymore.
It's the equivalent, right?
And finance. Yeah, it's the same thing. Whether you're dead or unable to work.
Wow.
Yeah, you've lost that expertise. That individual brings to the business. So that is where we see different forms of insurance to finance that piece. Now, in many cases, we don't need very expensive permanent insurance to do that. We'll usually use things like term insurance, temporary insurance. I've got two business owners who are, say, 40 years old and they're starting this business together. I might do a 20-year term and take them to 60, or a 25-year term and take them to 65, and just say, look, here's a term policy. It's not too expensive relative to, obviously the amount. If you need a $50 million term, 20 won't be inexpensive. But I'm pretty sure that if you have a $100 million business, you've got the cash flow where you can support that premium. And that's just a small cost that you pay into going, just in case, what if something happens, the cash comes into the corporation. Once again, I've got a $50 million policy on you, Pierre, and you pass away, car accident, whatever. That cash comes into the corp. It's tax-free to the corp. I can now go and buy out your shares.
Right.
Your family's made whole with cash. I'm now running the business, and that's a good thing because your spouse is a lovely, lovely person, but they know nothing about her business, and I don't want them anywhere near my business. Easy peasy. Hey, children are awesome, but same thing. I don't like the work ethic. I don't want them in the business either. Sorry, pick on your family here a little bit, but it gives you an example of those. That often is what happens. The surviving business owner doesn't want the spouse or the kids involved in that business because they either don't have those core competencies or don't have a work ethic, or they're just going to come in and go, well, I just want to get paid without doing any work. No, that's not cool. I want your estate out of my business where I can move that business forward. And that life insurance allows me to do that. No headaches. Nice, it's nice, seamless. Family gets the cash, they move on, they're happy, I'm happy, I've got my business, and my business continues to grow and thrive. And that's, it really makes life a lot easier. So it is important that you have a well-drafted, modern, updated buy-sell agreement as part of the overall shareholder agreements, of course. Right. And like you said, it is somehow funded. You know where this money's going to come from. Because without it, it's nice to have a buy-sell agreement, but if you can't afford to execute it, it's just a useless piece of paper.
There's no substance.
One thing,
And is it also important, Eric, to understand the vision that the partners have? So, for example, a startup with a couple of guys that intend to make a huge tech exit within 10 years and sell the business, sell the IP, versus somebody who wants to run that business forever and make it a legacy.
Yeah, absolutely. And that falls into the planning process. So let's go back to my earlier example of, say, 240-year-olds that start this business. If it is one of those, say it's a tech startup, 10, 15 years, we tend to spin this and sell it even faster if we can. Well, maybe I'm not doing a T20, T25. It might be just a T10 to fund it at that point in time, where we change the solution with that understanding of going, okay, we may need to update this in the future. If suddenly your tech thing takes off and you're like, well, I'm actually not selling it because I'm making money hand over fist on this thing. Yeah. Okay, well, now we need to look further and update this. That T10 now perhaps needs to be converted to a permanent plan for that post-mortem plan we talked about a little bit earlier at the top of the show. We now convert that. And that's the beauty of term life insurance, is that while it is inexpensive, you have the ability to, especially in the startup company, have a bit of insurance that's not going to be financially, won't financially impact the company, especially if the cash strapped. It's much more affordable, but it creates that funding, but also the flexibility of converting it into permanent when those needs and if those needs change. And even those business owners, if they do sell the business, they're probably now going to have a holding company with a whack of cash in it and are going to have a problem at some point in time. They just get any tax liability. So we're going to take that term and convert it. So it's really, really powerful. So yeah, if you've got some clients that are going, hey, I can't quite afford the insurance just yet, start them on term. We'll convert it later on. I had a case of a business owner years ago, or actually pretty early in my career, bought a business. Well, they were second generation of business. This had been a family business for about 50 years at that point. And they had just acquired one of their main competitors, heavily leveraged to do it. But as a result, they needed a couple $1 million more of personal life insurance for this now increased future tax liability. We started with a T10. We looked at permanent insurance. The cash required to start it would have been adverse impacts on the company's bottom line. So we wanted to make sure that they can afford that premium. We started with 10-year term with the intention to convert it once the dust had settled, once the business had really finished merging and that cash flow was now coming in. Client dropped dead of a heart attack 14 months later. We could have waited till they could afford the permanent insurance. If they wouldn't have had that additional coverage. Instead, they had the additional coverage, and they ended up using that to pay off some debt. So the next generation used some of that cash to pay off some of the debts acquired when they merged the two companies. So at the end, the value hadn't quite increased yet. So the tax liability wasn't there. So they repurposed it. Repurposed it in such a way that the family said, we have even healthier books now that actually let them acquire a third company. So they actually use this life insurance to leverage and acquire a third company. And in spite of the death of one of the main partners, got even bigger. The next generation came in, with their uncle at this point, and it got even bigger. So it's quite fascinating what you can do and how you can repurpose it depending on needs. So never, ever discount term insurance. I know some advisors call it renting insurance, and it's bad insurance because you rent. Sometimes renting is just fine. So let's not be insulting term insurance here. Let's use that when we need it and be ready to convert it when the client's cash flows get a little better. We convert it to permanent, what everybody wants and needs for estate planning. We need permanent insurance for that. There's some great opportunities there. And I think that's a good example that I learned early in my career of don't mess around, just get the insurance in place. No matter what you put, just get it in place.
Yeah. Start where you can.
Yeah.
Eric, before we get into that's extremely enlightening. I don't think one thing that came to mind, a little earlier was, this idea that I just can't help thinking folks are not thinking, business owners are not thinking I need a 20, 30, 40, $50 million policy.
No.
And we just don't think in those terms when it comes to insurance. But when it comes to protecting a business, protecting your partners, protecting your family against against, failure like that, failure caused by death or disability, I would hazard a guess and say, the majority are not thinking that way yet because they haven't come to that place in knowledge where they know they don't know about something even, it's still don't know. And, but Eric, I just want, before we get into, I want to get into the conversation, or before we get into how to open the conversation with a business owner, we want to step back for a moment because there's a framing problem underneath all of this. You brought up the fact that, many people think of insurance as might still think of insurance as a bad word or have some bias about what it is or where it fits. I know I did as a former advisor, which when I look back on that, I think, boy, when you think, hubris is such a cause of so many problems where people are just overconfident or just don't consider, the downfalls that they could potentially face. Most Canadian business owners, and frankly, most advisors, think about life insurance as a retail protection product, something you buy when you're young, when you have dependents, when you're worried about income replacement. That's not wrong, but it's incomplete in a way that has real consequences. And Eric, you work in the large case world. You've seen how the most sophisticated families actually think about this. Help us reset the room. The wealthiest families in the world, going back many, many, many generations, hundreds of years, have never thought about life insurance the way most people do. How have they actually used it? And what does it reveal? What does that reveal about what this strategy really is when it's used at its highest level?
Absolutely. So some of the wealthiest families use it in two different ways. They do what we call cascading strategy. If they're doing it on the personal side, using personal assets. And if they're doing corporate assets, they are taking advantage of things like what we call the capital dividend account, where life insurance creates a tax-free dividend that you can pay out of a corporation. And I'll come back to that in a few moments. On the cascading side, we're basically taking advantage of existing provisions in the Income Tax Act that allows you to roll over certain assets from one generation to the next tax-free or at the ACB instead of at fair market value to avoid capital gains taxation. Probably the most common example that people will be aware of will be things like farming property, where you can, from one generation to the next, roll over the family farm or shares in a family farming corporation, can go from mom and dad to the children, and from children to grandchildren, and just generation. You can roll that over at the ACB if you want. But within the Income Tax Act, there are some provisions as well, especially with life insurance, where you can roll over an insurance policy from one generation to the next. So that is what they'll often do. So mom and dad will, when they have children, when they're very young, presumably not long after they're born, they will go to their insurance agent and say, we want to buy as much life insurance on this newborn as we can. That they're going to roll over millions of dollars in premiums into this insurance solution on their children. And they'll do it for every single child that they have. And the idea is that when mom and dad get a lot older, they can now take that permanent life insurance policy that now has millions of dollars of cash surrender value in it and an even bigger death benefit and roll that over. You are allowed from mom and dad to roll over to your children a policy you purchased on them. It rolls over at the ACB. So the parents are taking money that is presumably in a non-Richard account, being taxed on growth every single year, putting it into this life insurance solution. It grows inside that insurance solution, tax sheltered. Mom and dad control it as long as they live. And when they die, it rolls over tax-free to the next generation. So now the kids receive this policy with millions and millions of dollars in it. And they can then say, well, I can access this. So they can either collapse the policy, pay taxes on the growth if they want, but most of them will leverage the policy and turn around and say, great, I'm going to use this to back a loan and start my own business or expand the family business. And by the way, this is something Walt Disney did. People don't realize this, but when he started his first park in Anaheim, he used a permanent participating life insurance, went to the bank and said, this is one of my assets. Lend me money, please. Here's my vision. So he used a permanent participating policy to start Disney, or Disneyland, should I say. That's in Anaheim. Disney World's in Florida. So at the end of the day, that's what that second generation can do. They can leverage those, those dollars. And if they don't need those dollars, they will pay out tax-free to the third generation or the grandchildren. So now you've got generation one, tax shelters the money, rolls it to generation two, who can leverage it if they need, and whatever they don't leverage pays out tax-free to generation three. The Income Tax Act allows you to do that, and that is what we call cascading. So that is one way that they kind of roll it all the way through. So on the personal side, they do this and they buy as much as they possibly can, and that's how they tax shelter a lot of those personal assets and just roll everything over, and it just gets bigger and bigger and bigger. For those who are dealing with a corporation, in a lot of cases, they will turn around and understand that I can use corporate dollars that are very efficient in terms of paying premiums, because corporations have much lower tax rates than individuals. So it takes less gross active business income to pay that premium than personal income. And they will buy as much life insurance in their corporation as they are legally allowed to buy. I say legally because at the end of the day, there has to be an insurable interest. We can't just sell you $1 billion life insurance policy when you don't have a need for it. There has to be an insurable need, but they'll buy as much as they possibly can, put it in that corporation with the understanding that, once again, they're tax sheltering those retained earnings, because as long as those retained earnings are inside the insurance solution, it's going to grow tax sheltered. And when it pays out the death benefit, it is tax-free to the corporation. But it then creates that capital dividend account credit I alluded to a little bit earlier that lets you pay a tax-free dividend to surviving shareholders. So you're basically using efficient corporate tax dollars, tax sheltering that money, and pulling it out tax-free to the next generation. Now it's in their personal hands, and then they use that cash to start the cascading strategy personally. And the cycle continues. And they just do it from generation to generation to generation. And when everything's said and done, they end up pushing that ACB up and higher, minimizing those capital gains taxes from generation to generation that they have to pay. And all of this is 100% allowed within the Income Tax Act. CRA knows about it, and they're A-okay with it, because at the end of the day, that's how insurance works. You pay with after-tax dollars, you get after-tax benefits. So they're not really messing around with that. So it's completely legal, but CRA said has no issues with it because most people don't bother with it. Because the minute they hear their insurance, they're like, oh, you're trying to sell me a product. You're trying to make a big commission. It's like, no, I'm trying to save you millions of dollars here. So it takes a little time to help increase that financial literacy of clients and some of those trusted advisors. In a lot of cases, we come across some accountants who will look at that and go, why are you going to be spending $1 million in premium a year? That's $1 million that I cannot deduct. Right. So accountants hate it because there's an expense that they have to put in the books, and they cannot do anything with that expense. So they're like, that's a bad idea. Not understanding what life insurance long-term can do. Yeah, you can't write it off, but you're also going to get a tax-free dividend in the future. And that's where the savings add up. And that is very, very powerful in the long run. So yeah, for a lot of those wealthy families, it's kind of those two strategies and combinations of the two that they tend to do. And they use life insurance to its fullest to ensure that money goes from one generation to the next completely tax-free.
Incredible.
And it's astonishing. I think it's one of those things that, when people find out, like for me, I'll speak for myself, but when I found out about this, or when I actually started to become more open-minded about this, that's the feeling. That's the light bulb, the aha moment is like, wow, I had no idea that I had no idea.
Yeah.
Right. And I think I suspect that most folks out there in writ large, don't know what they don't know. And the same goes for advisors. I think, when we have these biases that close us off and we don't realize that we're closing ourselves off to these ideas that do require open-mindedness, the feeling I get is that the feeling that one gets from this is that, only those who know about this are doing something with it. And all the folks who think they knew or think they know are not. And so you have to decide, which camp do you want to be in? Which camp do you want to get your clients into? We're all universally interested in the topic we're talking about today. It's just a question of whether or not we allow ourselves to entertain these age-old ideas.
It's absolutely amazing how there's an old expression we've all heard, it's too good to be true. We've all heard that. If something looks too good to be true, it's usually a scam or, not right. And that's just inherently, we know that when something looks too good, you're like, I don't know about this. So when we show them life insurance and what it can do, the reaction that I get from a lot of those business owners, their initial reaction when I show them on paper, here's the values, here's the strategy we're going to put into place. Your accountants will do this, this, and this for you. We'll instruct your accountants on what that means. Our accountants in-house will share that with them so they know to do post-mortem. Then we're going to put some insurance policy, and we've grown the value of your estate. And we've eliminated a lot of tax, or we've made it and we've financed some of the tax, and we've created more money for your kids. Their initial reaction is like, no, that can't be legal. There's no way CRA lets you do that. That's too good to be true. This is a scam. You're scamming me. I'm not buying anything from you. Get out of my office. And like, no, I promise you, this is 100. This is that one case that I promise you, it's not too good to be true. It honestly is true. And sometimes you gotta crack that nut and just get through to them and go, no, this is real. Just bring your accountant in. I'll bring my accountant in from the carrier. They'll talk accountant to accountant. They will go through them here, section this, section that. They get into accountant speak where they just start rattling off all the sections and all the numbers, 232-6 and over my head. And by the time that conversation's done, the client's accountant will look at them and go, they're onto something, we need to listen. And then we proceed and move on from there. And that's often what ends up happening to the client. They go, too good to be true, this can't be real. It is, I promise you. But a promise isn't good enough. They need to see it, and they need that trusted advisor who understands it to learn it themselves, and then give them the nod of, Eric, his advisor, this is legit, this is for real, proceed.
We have a clear picture of the problem, and we have the longer historical view of what insurance actually is at a higher level. The question now is, how do you actually start a conversation with a business owner today? Because most business owners may have predetermined ideas, may think that they have it covered. Eric, you helped a lot of advisors open these conversations. Walk us through how you get in the door. What are the 2 to 3 questions that actually open a business owner up? The questions that get past my accountant has it covered, my lawyer has it covered, and get the business owner really thinking honestly about what happens the day they're not around to run the business.
So that can be tricky, because every business owner will think differently, and there's some different approaches and ways that you can go. I'll take you through. I have basically what we call 2 napkin approaches, and I might have just dated myself a little bit. I call it a napkin approach and be like, what's a napkin approach? So I have a couple of those that'll take you through. And one specific one that I think is great for any advisor that maybe you're new to the space and are not well versed in integration of personal and corporate taxation, or maybe they're a little bit new and they've got, there's a business owner in the natural market and they're like, how do I approach them? And I think I'll start with that one, and then I'll kind of come back to some of those, we'll call the napkin approaches, or the conversation starters. We talked a little bit earlier about buy-sell agreements. Well, in my opinion, shareholder agreements, of which buy-sell forms part of an overarching shareholder agreement, I find is a very non-intrusive way for someone who's trying to show some credibility and just engage with a business owner. It's a great, I think, entry point. You can ask any business owner and say, hey, you've got this great business over here. Were you aware that most businesses fail because they don't have a strong shareholder agreement? Something happens to one of the founders and everything collapses around them. As a friend of mine or neighbor or whoever they are to you in the natural market, I want to make sure that you're taken care of. Tell me about your shareholder agreement. What agreements have you put in place to make sure that your business, survives long term? It's a very non-intrusive one. I'm not asking financial questions. I'm not asking for numbers. I'm simply stating a fact, trying to create a little bit of discomfort, and then a nice open-ended question about, tell me about the shareholder agreement. Some of them may turn and go, what's a shareholder agreement? And that's what I'm trying to get them to do. You're trying to get them to engage with you by asking you a question or making you say, well, tell me more. And if they ask, well, what is a shareholder agreement? Or I think I have one, I'm not 100% sure what's in it, or it's been a while since we looked at it. There's your opportunity as an advisor to dig a little deeper. Okay, well, tell me a bit. Well, how long has it been? Do you feel that maybe it's time we revise that or took a look at it? Part of what I do as a financial advisor is work with business owners to make sure that these agreements are properly financed to ensure the long-term financial stability of your organization and your business. This business is your baby. We want to make sure that it's taken care of. And that kind of opens the door. Hopefully gets you that mandate to go in and do a fact find, get that discovery process going. And then you can bring all of that and go, okay, begins discovery. I don't know what I'm doing anymore. And that's where resources like myself come in and help you with those businesses. But I like that approach because even if you're newer in the business, it's not hard to learn about shareholder agreements. There's lots of great articles out there. It's kind of low-hanging fruit in terms of just learning and being comfortable with what are shareholder agreements and the different aspects of it and how to explain it to a client. It's not a huge ask to understand this and become a bit of an expert in it so that you can talk very credibly with a business owner, build that credibility, is it in a very non-intrusive way without getting into taxes and numbers and all that jazz. It gets you in that door. So I recommend that to a lot of people trying to get in. Become an expert on shareholder agreements. Use that as your entry, and hopefully that gets you the mandates. And from there, we can work out how do we take those next steps at that point. But step one is just get in the door. If you can't get in the door, everything else doesn't matter. So that's kind of number one for me. The other, call it napkin approaches that we use, I try to keep them very high level because most of the time it's in conversation. One of the questions that I will often ask some business owners, and again, you got to be comfortable with taxation and really dig into these two, is I'll often ask them and say, well, how would you feel if I could show you a solution where for pennies to the dollar, I can take care of that dollar liability for you? Because right now, you are probably going to light upwards of $1.50 on fire on death to pay that dollar liability. But I can help you pay, spread out a couple of pennies over a few years, and I'll take care of that solution or that problem for you. What do you think of that? How do you feel about that? Most of the time they're going to look at me and going, I don't understand anything of what you just said. What? Perfect. You've just asked me the question. That's what I'm looking for. I want you to go, huh? Tell me more. I'm like, well, think of this. You've built your company up. You've built, this little mini empire of yours. It's created a tax liability. At some point in the future, you're going to have to pay capital gains on all of this. I don't know what that number is, but let's just pick $1. Let's just simplify everything to one single dollar. If you have $1 of tax to pay at death, if you don't do any planning, you might have to sell $1.50 worth of assets to net the $1 because you have to sell that $1.50 of assets, pay taxes on it, and depending on the assets, you might even be selling it at a discount. Let's say you were real estate holdings, for example, you own a lot of buildings. Well, if you die, you might find yourself having to sell a building or two to pay that tax bill. Well, no one's going to pay you top dollar for a building if you need to unload it and unload it fast. You're going to have to put it below market to sell it quick, pay capital gains on those buildings to net the dollar. So you can light $1.50 on fire to net that $1. Or if you are willing to put money into an insurance solution, for every dollar of death benefit, it's a couple of pennies a year for the next 10, 15, 20 years only. So you're going to put a few pennies in, maybe over 20 years, you're going to give me 40, 50, 60 cents, whatever it is, and I will take care of that dollar for you. As a business owner, what costs you less? A couple pennies a year over 20 years for the dollar, or $1.50 on the back end? What would you rather spend? What costs you and your family less? The smart ones look at me going, those penny of the dollars seems to be a lot better way to go. Correct. Let's get together and look at your financial plan. Let's look at your estate plan and start analyzing this, and how can we set you up so that you end up paying pennies to the dollar instead of $1.50, $1.60 on the back end. That opens up quite a few doors as well.
Incredible.
The last one, and this is one many people have probably heard. We all know that, the two certainties in life are death and taxes. Well, on death, we have to pay taxes. But what a lot of people don't understand is that when you die, you have a choice. You can leave your money to your family, you can leave it to charity, or you can leave it to the Canadian Revenue Agency, CRA. You have the ability to choose two. With no planning, CRA has just become one of your children who take half of everything, and your family get the remaining amount. With the proper amount of planning, I can help you choose which two you give it to. You may say, well, I don't care. CRA is going to take a little bit, so be it. All right, with a bit of planning, I can help minimize that, leaving more for your family. I can minimize what CRA takes. Or if you say, well, no, I want family and charity, I don't leave money to CRA, great. We need to plan for that, because without planning, CRA is going to take more than half. But with the proper amount of planning, we can either reduce it, or I can leave a lot of money to charity and your family, and maybe even completely cut CRA out. Because what a lot of people don't realize is that when you do die, on your final tax return, you can create a charitable donation that can write off 100% of taxes owed. It's the only time you'll just write in around death, and you can carry that over about a year or two when you serves. But that is one of those exceptions where with a really large charitable donation on your final tax bill, you could eliminate all your capital gains taxes. Suddenly, CRA gets cut out. You've created this huge charitable foundation that your family can run, and the family gets the rest of the estate. Point being, the family controls everything, including the charity. How do you feel about that, Mr. and Mrs. Business Owner? Once again, for those who are into philanthropy, that gets their attention. If they're not in philanthropy, not so much. The pennies to the dollar, the shareholder agreement, they have a little more success. Those are kind of three general, simple conversation starters that I find usually gets their attention, gets them engaged. And then you need to go in, very importantly, do the proper discovery process, the proper fact find, ask the right questions, get all the right data. That allows myself and my team to analyze everything for you and put together the case and really build this out so that it makes perfect sense to the client and customize it and tailor it to them. So they look at it going, I like it, this makes sense. And they proceed with that plan, because it's great to get in the door, but if they don't do any planning, they're no better off. So we have to succeed, A, get in the door, and B, convince them to proceed with a really short plan.
Very powerful.
Amazing.
Very powerful, Eric. First of all, if you're talking to somebody for the first time, prospective possible client, and you bring up any of the three topics you just covered, if the response is, oh yeah, we've got the basis covered, we've got a great insurance advisor, blah blah blah, then you're talking to somebody who's actually done some of that work already.
Yeah.
It's not that you shouldn't continue that, but if they think they're already covered or they've got some comprehensive plan in place, then you can change directions, obviously, and lead somewhere else. But but if you're leading on, I think if you're just openly leading, whether you're in wealth management or you're in insurance management, if you're leading with that question and the initial response is, wait, what? I don't know what can you tell me more? then you know right away you're dealing with somebody who potentially has a need, maybe even a great need for what we're talking about today.
Absolutely. In a lot of cases, when I hear, oh, I have the life insurance already, or I have an insurance advisor in place, that's great. I like to follow up and say, okay, so they've got a great plan in place. Awesome. Tell me, what post-mortem planning did they establish for you? I ask that one follow-up question. Because what happens from there, what transpires from there, one of two things. They're going to be, what's post-mortem planning? So, well, it's great to get life insurance, but that's just one of many facets. What provisions have you put in place in your will and with your accountants to take care of that post-mortem, or what happens after death, to avoid double taxation, to maximize the use of insurance? Was this discussed during your planning process? If they go, I don't think it was, you have an opportunity then to step in and say, all right, with your permission, let's have a conversation. Let's dig a little bit deeper. Take the plan you've already put into place, and let's just give you second opinion. Is kind of the easiest way of saying, not second opinion, but let's see if we can build on that a little bit and make sure that you're not inadvertently leaving really huge opportunities on the table to maximize your estate and avoid paying CRA more than you have to pay. The life insurance is an amazing first step, but there's so much more beyond life insurance, part of that full plan that we have to take into account. When you hear that, I tend to follow up with that one. Now you have to be comfortable with what that means. What is post-mortem planning? You have to be comfortable with that. Otherwise you're asking a question, and if they ask you, well, what does that mean? And you just look at them going, and I'm hoping you're going to ask me that. That's not going to work very well. So it doesn't work for everybody, but certainly when I hear that, that tends to be my follow-up question, to at least still give me an opportunity to maybe get in the door and see, are there more opportunities for planning? Sometimes they are well advised, and I can go to them and say, you know what, you are well advised, you're in great shape. Congratulations. I'm really happy to see that. I'm sorry I may have used up some of your time, but I would hope that you as the client, will appreciate that this second opinion has just confirmed you're in good shape, so you're doing really well. Or I walk in and it's like, yeah, there's a life insurance, but there's not enough. There's no buy-sell agreement in place. So suddenly it's like, oh, well, hang on, there's key person opportunities here. There's the buy-sell opportunity. Heck, there's even personal stuff. One of the big things that I often see is an insurance advisor will put the big policy in the corp and ignore the personal needs, thinking, well, if they pass away, there's $10 million in this corporation. We've got a $3-4 million insurance policy. How much more can the family possibly need? Forgetting that, and this is something that Pierre, that you mentioned, earlier on as well, money can be locked up in the estate through probate for years. Meanwhile, the family may be quote unquote wealthy, but if the wealth is inside a business that they can't touch because it's in probate and the shares are in the estate and it's the executive in the estate controlling it, not the family, well, they still have financial obligations. There may still be a mortgage to pay, and there's still bills to pay. There's still an income need. I often go in there and say, you got this really big policy that's nice. What about on the personal side? We need to make sure that if you pass away, there's immediate money going to the family. There's no personal insurance in place. We need maybe a little bit of term insurance just for the family. Mm-hmm. I have that conversation, and suddenly they're looking at me and they're like, maybe my insurance advisor hasn't covered all the bases. Yeah. There's cracks there. Go find those little cracks, and there's opportunities there for you to still bring them in as a client, show them that you can bring more value. And now suddenly you've become one of their advisors. And perhaps as the business grows and they need another larger policy, maybe it's not that initial advisor that gets the business. You end up receiving it because you found those opportunities, you found the cracks in what they thought was a really good plan, purely by asking the right questions. So there's another great opportunity there. Is going, you have this, great. Is the personal side set up? Your business is set, but on the personal side, what happens? Is there cash immediately going into that family, or are you waiting for the business money to come in? Because that could take years. probate is not a fast process. It takes time, and the more complex the estate, the longer it takes to roll through that entire process.
Yeah.
So that really
Eric, thank
touches
you.
on something that you've touched on earlier in the beginning of our conversation, which is the equalization problem. One child wants the business, the others don't, or uninterested, unqualified. Or even a buy-sell situation where the heirs to the deceased shareholders shares are just disinterested. There's rather than just a logistical problem, that's a family harmony problem masquerading as a financial problem. How do you use that scenario to help an owner see that this isn't about insurance, it's about fairness and control?
End of the day, it's all about asking the right questions. And I can even go back to that earlier list where I had those, my 2 napkin approaches, and even a third question that you can ask them that's not related to the shareholder agreement, can be, tell me about the equalization plan. What have you put in place to make sure that everybody in the family feels that they're being treated fairly? Or even ask, have you had those family meetings? By asking some of those questions, it will usually get them thinking about something they have not thought of before. Because again, mom and dad in their mind are like, well, kids are inheriting, like, we built this up, they're going to get what they get. Like, this is our money, they should be happy to get. Some parents, that's their attitude, and gratefully so. At the end of the day, it's like, if I build up assets, I'm the one who built it up. I worked for it, I built it, I took the risks. Like, if my children, nieces and nephews or whatnot inherit it, well, they get what they get and they should be happy because they had nothing to do with the building of it. Not thinking about that family harmony. Well, what about that impact later on? And it comes back to me, saying, we've all read in the headlines, someone dies and everybody's fighting for it. Heck, I've even seen it, in families with very little money. And sometimes it's even worse in those cases, because now all of a sudden they're fighting over things. And it's like, well, I want, grandma's ring. I want grandma's, pasta pot because it somehow, there's 50 years of tomatoes burnt into it and it makes the best spaghetti, whatever. Then they fight over that stuff. And that's where you got to say, no, tell me about your, estate plan and the plan to harmonize everything. How are we equalizing? How are we making sure that everybody feels that they're being treated fairly, to avoid the family squabbles, to avoid your family being torn apart? It's bad enough that they lost a parent or both parents. Now they're losing siblings too. Tell me about that plan. And then we can have those conversations. They may never even thought of it. And that's where a valued and trusted financial advisor who understands the idea of family meetings and breaking the taboo of talking about it before it happens and saying, these are our intentions. We are doing A, B, C, D. This is why. Well, you have 3 children. One children's going to get a $10 million business. My other children, you will share the remaining assets 50-50. There may be 3, 4, 5 million there. So you're each getting 2.5 million and this one's getting 10. Here's why we think this is fair. You're each going to get 2 to 3 million cash. That is money that will go into your bank account. You can do anything you want with it. You can invest it, grow it, guarantee your retirement. Whereas this one child here may be getting the business, but that business needs to be worked. They have all the risks. If that business goes under, they can get zero when everything's said and done. If, the Walmart of our industry comes into town and wipes out the small businesses, we can get wiped out by their competitor. The markets can change where suddenly this item, this widget that we produce may become obsolete. The business could become worthless. So yeah, they're getting more quote unquote money, but it's in the form of a business with huge risk. That's why they're getting a little bit more. I mean, you're getting cash. We believe it's fair, to our 3 children. Here's why we think it's fair. Let's discuss it. 2 children aren't getting the business after that conversation. Like, no, we really don't think this is fair. We want a piece of the business. well, then other discussions and perhaps other arrangements need to be made to avoid, catastrophe within the family of all that infighting. Or perhaps that one conversation opens the eyes of these other two children that are not coming into business to say, you know what? Yeah, that makes sense. I get 2-3 million cash. I get to do whatever I want with it. I get to play. I get to have fun. My sibling over there has got to work 6-7 days a week and take all those risks. You know what? You have the business. Good luck to you. I'm taking the cash and running. And there's your harmony. So that comes back to what is fair is not always equal, and what is equal is not always fair. So it really comes down to, having the courage as an advisor to ask about these things to your client or prospects, and the wherewithal to suggest the family meeting, describe the family meeting, and being there in the room for what could be an awkward conversation. Because sometimes it can get a little bit awkward, and you need to be in the room taking notes and saying this, here's the family members, what they're saying, because chances are that financial advisor, while they legally cannot be the executor, you cannot be the executor of one of your clients, you will probably be working very closely with the executor to help them and be involved and say, well, look, these were the wishes. Here's the insurance. Here are the assets. You work with the executor to liquidate the estate. But if you were in that room, who's getting what, why, and whether or not they're all on board. And if someone's not on board, that you gotta pay a little extra care to this one person who's they're gonna give you a hard time. So let's just make sure to appease them. To look at it. So have the courage, have the conversation, wherewithal to bring this up, and to be in that room for those awkward taboo, which shouldn't be taboo, but those taboo conversations with family, lay everything out.
One of the hurdles advisors have, of course, is that insurance is a whole other expertise that they're not necessarily, steeped in because of one reason or another. And there's many reasons why that could be. But for a wealth advisor or an insurance advisor who actually understands what we've talked about today, understands the problem, understands the conversation, and doesn't have the large case expertise in-house or in their team, how do they actually get this done for a client? Where does the expertise live inside a firm like yours, like IA Financial Group? What does the referral or collaboration model look like in practice? And what should an advisor expect when they bring in a specialist like you?
Yeah, excellent question. And it's fascinating how many advisors don't realize that these resources exist. A lot of them are scared to start these conversations because they don't know where to take them once they have been. And in some cases, they don't even know how to start those conversations. So the reality is that many advisors, if you work with some of the larger MGAs, those MGAs might have large case expertise in-house that can work with you, but certainly all the different or most of the major carriers do have a large case team. So specifically with, at IA Financial, we have, the advanced case sales directors like myself. We quarterback everything kind of from start to almost finish. So part of my role is to work with an advisor if needed from the very beginning, even before the initial conversation. And I have quite a few of these where advisor will call me and say, hey, I have these 2 or 3 prospects. Here's what I know about them. What do you believe is the best approach? And it goes back to our conversation a few moments ago. What's a good approach to get them, to get in the door? But more importantly, how do I do a fact find? I'm used to doing, mom and pop kids. I've never done a corporate discovery.
Yeah.
So I work with them and say, well, here's some corporate discovery tools that we have at IA Financial. Share that with them, walk them through the types of questions we want to be asking to gather that data. They then bring the data back to me, and I'll work with our advanced financial tax solutions team. And they comprise of multiple tax lawyers, tax accountants. We have CFPs that specialize in everything from, Bay Street corporate structures right through rural farming specialists, all in-house. And we'll build that financial plan for them and say, here's a plan, start to finish. Whether it be that wealth plan, the risk management plan, we'll integrate that in and show them, here's what you're currently doing, what's going to happen. Here's our suggestions of how we can tweak it to make it better. And here's us inserting an insurance solution and how it drives value and how does that all work together. So we'll build that whole plan for them. They'll get, the PDF report. They'll get the PowerPoint slide deck. So if they want to present it on their screen or on their laptops, it'll look pretty fancy. We put all that together and we walk the advisor through everything, and we make sure they're comfortable and they understand how this works and answer all their questions so they now have the confidence and expertise to present it to the client. Once the client accepts, we then bring in the application and then moves into we call our VIP underwriting. That's a group where all our large cases go in, where we have a group of dedicated underwriters and case coordinators that only do large case. They understand the complex. They're well versed in these cases and can understand it. They're not going to bat an eye if I show up and say, hey, I need, here's $100 million death benefit. They're going to look at that going, nice case. Tell me about it. This is fascinating. We don't see a lot of these, but they're not going to be like, oh no, $100 million death benefit. What do we do? They're like, yeah, no problem. We see these. We're used to it. So they will then take those cases and have regular touch bases with the advisor. So the underwriter will call the advisor on a regular basis, have a phone conversation. Or for those who like face-to-face, face-to-face, we'll do it over Teams. So virtual face-to-face, I should say. We'll do Teams call. So the advisor can put a face to the underwriter's name and walk through the cases right on through to issuing it. So we are there to support them from how to start the conversation, to the right questions, to developing that case, to presenting it. We're right through to underwriting and issuing it, and even the post-service afterwards. But certain cases do require every year new, we have to give certain reviews, certain things need to be done on an annual basis. So we're there to help and support those conversations. So they're never truly alone. And that really is there to help in those cases. And the beauty is you don't split a commission with me. I'm paid by the carrier, so IA pays me to do this with you. Obviously, I'm proposing an IA solution. If you're going, I want to do a different carrier, well, I'm not going to show you to the carrier solution, obviously. But at the end of the day, the reality is we can take it from start to finish with our solutions. We've got lots of great solutions for clients that can meet those high network needs. And I said, we've got a very large team from coast to coast across the country that's in a position that do what I do. There are 6 of us across the country that quarterback the sales, and we're all supported by that same large team, advanced planning team that build those plans out and put everything together for you. So there's a really robust, structured IA financial to help those conversations.
Amazing. That's a real asset for our advisors.
For advisors out there who are concerned about protecting, putting a fence around their clients, you have all, you're used to working with collaborative agreements, MOUs and predetermined boundaries, all in writing, signed off on in advance. So you're not going into this as a black box, not knowing what's going to happen. All these steps, all these conversations are all documented. It's a very transparent relationship that you could potentially strike with Eric or his counterparts. I thought I would cap that part of our conversation off with the fact that for advisors who are concerned about bringing in another consulting advisor, large case specialist like yourself, that you're not going to run away with their client.
No, absolutely not. At the end of the day, and that's an excellent point, I represent the advisor. That is what my role does. I'm there to help the advisor make the sale, help make it simple, answer some questions. I'm there to make the advisors look like a superstar. I want them to feel like a rock star, to look like a rock star with their clients. Because when that happens, they're confident. Confidence, builds credibility. Like you see that. I want them to be really confident that when they meet their client, they've got a great solution in place. And I represent the advisor. We don't share commissions. We don't take the client. The reality is if anybody in my role start playing those games, we'd be terminated on spot. Like it's written into our contracts that we do not cross, that boundary.
Right.
We are there to help drive the advisor's business. And that is what we are, employed to do at the carriers. So yeah, there's absolutely, there's no hanky-panky with clients. The advisor controls the client relationship. The advisor always has the final say in any strategy. So if we put a strategy together and the advisor's like, I don't really like this, or I want to change that, we can absolutely change it. Well, you want this, not that? Sure, we can modify that. I mean, we can tailor this to your comfort a little bit. If you go, at the end of the day, we're there to work with the advisor in collaboration with them, but the advisor always controls the relationship. It is their client. It's never happened to me where a client behind the scenes reaches out to me and says, hey, Eric, I want to do business with you. That's never happened, thankfully. But if it ever does, that will be shut down immediately, because to me, that's just a no-go.
You and your team and your resources are not just available to IA Financial Group.
Correct. So it's available to any advisor that has a sales contract with IA. So to any MGA. So at the end of the day, national accounts, MGAs, or anybody that is licensed to sell insurance have the ability to, through their MGA, open up a contract with IA Financial. So it does require requires a sales contract. We need a sales code, because ultimately, if you're going to sell one of our products, we need to know who you are, right, where to send the payment to, et cetera, et cetera. So you have to have a sales contract so we can establish that business relationship. Once that is established, we are then there to support you, no matter where you are in the country, no matter what your interests are, your expertise are with insurance. We're there to help and support. So it is open to any and all advisors that are licensed in life insurance.
And what's the best way to get in touch with you, Eric? What's the most effective way?
And there's lots of different ways. For those who want to reach out, you can certainly, email me. I am on LinkedIn, so I've had some advisors where I do some webinars. So I've had a handful of advisors who see me on a webinar and then through LinkedIn reach out to me and want to connect and send a note going, hey, I've got a case. Can you please reach out to me? So that's probably an easy way. Or you can certainly, email me. I think LinkedIn may be one of the easiest ways to find me, or just go to the IA large case website. Just Google IA large case. It'll take you to a dedicated website with resources that are open to all advisors, by the way. You can go in and access some resources there that'll help with your practice and your business. And you'll certainly find myself and my counterparts will all be there and easy to reach through a few clicks of the button. At the end of the day, there's one piece of advice that I can share with everybody. When you're getting into the business owner market, just remember, they're people like you. Whatever you've done to be successful in this business and whatever market you're in, if you're trying to move up market, don't do anything different. The reality is that business owner puts their pants on one leg at a time, just like you do. Their needs are the same as anybody else. It's just scaled up. There's a couple more zeros behind the solution. But just remember that, don't panic. Treat them like you would any normal client. Don't reinvent the wheel. Approach them like you would any normal client. Do what's made you successful, with just the understanding that we just simply scale everything up a little bit. Yeah, sometimes there's more complexities, corporate and personal taxation integration, but that's where the expertise of large case teams can help you and help with that aspect. But just treat them like normal human beings, have a conversation with them. You'd be amazed how receptive many of them will be when you treat them like a normal person and not this mythical creature that we call business owners. They're people just like us. Treat them that way, and they'll be very receptive to some of your ideas.
And that's probably the most helpful thing that you could tell an advisor, not how to sell it, not how to adopt complex strategies, just really how to think about it, and that they are, their prospects, their business owners are normal, everyday people just like them. Mm-hmm. Great takeaway.
Fantastic. Eric, wow. I mean, what a conversation. I think we covered a world of ground in an area that definitely needs to see more light in the advisory field professionally, Mm-hmm. And I think the most surprising thing here is how professional and how sophisticated it actually is. Mm-hmm. I think most advisors will find that. And Thank you. Thank you very much. That was an incredible hour and 20 minutes that we've spent talking today. Thank you so much for being with us on Cover Your Assets.
Thank you again.